You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
I don't think we see prices below $100 a barrel for any sort of 6-month sustained period ever again. That's just the way the price of energy is going up, and then inflation is also bringing everything up. So yeah, that's sort of the one price I'll run with, and then the one overarching statement to kind of run with is if you're looking at investments from a 1, 2, 3, 5 year perspective, that's where I run my model is, hey, can we see sub $100 barrel for 3 months? Sure, but not for a 6-month period ever again.
Welcome back to Mining Stock Education. I'm your host, Bill Powers. Hopefully you're having a great holiday season. It's just after Christmas and the new year is upon us. And in a sector I'm interested in for next year is the oil and gas sector. I take a bullish slant to that. Also, I'm interested in the Canadian oil and gas sector, which I think is set up to possibly do very well over the next couple years, especially if the oil price continues to move upwards, or at least stays where it's at, or maybe a little more. And so joining me today is Shubham Garg. He is the CEO of White Tundra Resources and White Tundra Investments. And I learned of Shubham through his YouTube channel, and I was impressed not just with his passion for investing in oil and gas, and in particular Canadian oil and gas stocks, but just the fact that he does multi-hour live Zoom broadcasts. And anybody that can do multi-hour live broadcast, just talk off the top of his head, share all his research. So I admired his focus and his commitment to this sector, reached out to him, asked him to come on the show. So Shubham, welcome to Mining Stock Education for the first time.
Yeah, thanks for having me. Great to be here.
So let's talk about your role. You're the CEO of White Tundra Resources and White Tundra Investments. What is that, and how did you find yourself in that role?
Yeah, you bet. So I guess my background is in petroleum engineering, University of Alberta, up in Canada, which is Alberta being one of the big oil resource and oil production areas. So just kind of got exposed to the sector through my family. And as I grew up, I just decided, hey, oil and energy is a place to be. Oil runs the world. The GDPs of any economy is basically tied to their energy consumption. So I went into that. And then while I was doing my studies, I figured, hey, I really want to be in the field. I need to know exactly what's happening from the ground level, from what we call the wellhead level, being the oil wells. So worked all over Western Canada, light oil, heavy oil, gas, worked in private junior companies, worked in some of the majors, and just tried to get as much understanding as I could about not what just happens in these spreadsheets, because we know that from the academic education, but also what happens in the real world. Where do these worlds collide? Where are the issues? What doesn't make sense? What doesn't add up? And what does add up? So did that for a bit. And then when I graduated, I decided to launch my own little consulting firm, White Tundra Resources. And once again, worked in the field. This was with a little bit more responsibility because I was running my own company that was liable, that was responsible for entire fields of production. So I used to operate the wells and then do the production optimization and the field engineering for those fields at the same time. Really learned a lot, made a lot of mistakes. There was lots of problems, but you also did a few cool things where production went up and all of a sudden the well was making way more oil or more stable oil. And through that, just really enjoyed that. But then when COVID hit, just before COVID, I'd been investing in oil and gas since 2013. Not the best run till 2019, but in 2019 things were shifting on the supply demand side pretty drastically, and went a little bit more into the investing side. And then when COVID hit, it was like, okay, I need to focus on oil and gas investing now because the opportunity is just so great. So invested a lot more money at that point, and then in March of 2021. Left the field / engineering side of things, went full time into investing. Took a few months off to travel, and then in September of last year, really formalized my investing career, if you will, and went into the small to mid caps and just began doing deep dives into these companies, really getting to know the C-suite, getting to know their operations, going to site and touring their operations, talking to their engineers, talking to their operators, and then doing a full, deep financial analysis into the health of the company and where they saw things going, the vision of it. And then, it's been fantastic as you know, in the oil space since 2020 and even since 2021. I mean, 2022 has been a absolutely tremendous year in the energy space compared to some of the other sectors of the market. And recently, I think I've been going more into the junior side. We've been doing some private placements. We've been going to some private companies. There's been very, very small amount of money coming in as some of the management teams see some opportunity, and we say, hey, if we can figure out where the diamonds are, where the gems are, we'll go in at a time where capital is very restricted. Me and my group comes in. We participate not just on the financial side, but we use our engineering backgrounds to then help the company and figure out what's the game plan here. How can we best capitalize these assets? And it's just been a great collaboration. So through that, I've been on Twitter, I've been on YouTube, sharing as much as I can about the oil industry, not just the financial, but also some engineering videos, some technical videos, trying to get people up to speed because the oil industry is very opaque. It's very hard to get information, especially on the technical side. So it's just a great little industry, and I'm happy to share as much as I can.
Shubham, let's talk macro oil, because your technical edge, your information edge, I think comes through in everything, your experience you just described there. So if you're looking at a little junior, you're able to analyze it better than myself or 99.99% of my audience. However, if the oil price goes in the wrong direction, the CEOs of these companies or yourself, we can't control that, right? So the first thing I always look at is, where is the commodity price going? And as I've been studying this with oil, I hear a lot of oil bulls calling for even up to $200 oil next year. And then I've studied some bearish oil voices too. What is your take on the bear versus bull thesis debate for, let's say, the next 2 years? And could you address some of the key arguments of the bears, please?
Sure. Yeah, this is a really sort of interesting way to discuss it. But so I think throughout the last 2 years, there's a definite bullish case that's obvious. Look, we've had underinvestment in oil and gas capital. Demand continues to go up. Some of the fields from a geologic engineering standpoint are declining. We're seeing issues with new exploration, not hitting the right amounts of fields that we need, et cetera, et cetera. And so the whole game plan in the last 2 years has been, where is the bear case? What is the thing that's going to derail this trade? In 2014, it was shale. Shale came out of nowhere. It added huge amounts of supply in a very short period of time. It was quite capital intensive, but the banks and the PE firms were willing to support that. So all of a sudden, they overloaded the market and caused this 6 to 7 year down cycle. So throughout the last year, some of the bear cases has been, okay, look, OPEC is just going to open up the taps and we're going to get this massive supply response. That has been proven to be false. Because OPEC does not have the extra supply response that they said they did, or that the market perceived they did. Some of the older fields that Saudi has, that Kuwait has, that Iraq has, have been tapping out. They've been declining in this terminal decline phase. Some of the other countries in the world that contribute less production are still declining at 5, 6, 7% per year, and it adds up in 100 million barrel per day market. The other bear argument was, hey, shale is just going to ramp up again. Like, why can't they do it yet again? And we've been doing a lot of work to show that some of the shale well productivity has been going up every single year, 2016, 17, 18, 19, 20, 21, and then now it's down. 2022 is the first year that the well productivity has started to come down. Some of the companies are struggling with higher decline rates. Their tier one acreage is getting exhausted. The internal cost inflation and the supply chain issues are creating headwinds. There's a lot of seismic activity in these shale acreages that's now getting to the higher magnitudes where people start getting hurt. So the shale bear thesis is still not fully agreed upon, but the data is coming out. I try to share as much as I can on that. And then the other big sort of bearish overarching narrative has been recession and the Great Depression, right? Like, okay, in a recession, oil demand falls. therefore oil prices fall, and so it's not a good trade. So right now where we are, there's a couple things that are mitigating factors to that. One would be that the world never really fully reopened. So when you're saying recession, usually any historical recession has been from a full oil demand, and then you take a recession off that. This time around, you take a recession off that, but then you have the world is still reopening. So technically the demand is still going higher, and that wedge, what the difference between that wedge is a point of contention. The other thing is, we can say recession when oil prices are $120 a barrel, yes, and demand destruction. But when oil prices are $75, $80, $85, the recession doesn't impact oil prices that much, especially not in a undersupplied market. So it's a long way of saying there's a lot of factors. We can't just use one factor and just run with it. We have to look at supply demand individually, each single country, and then each single product. So where is the demand? Is it like, for example, right now we're missing about 1.5 million barrels of jet fuel demand. So, okay, we can have a recession, but we're already 20% below our normal jet fuel consumption. So is the downside really there, or is the upside just going to be slowed because of a recession? And that's some of the bear arguments that have been coming out. There are other areas like some individuals are saying that Russia is going to add a bunch of supply. That's been shown to be false. Some are saying that the demand hasn't come in yet. But if we go back and look at a 50-year chart of world oil demand, it's the cleanest, straightest line you can see. Yeah, there's a 2008 crisis. Yeah, there's some issues in China. Yeah, there's some issues in the 1970s in terms of Iran and everything else. But if you just aggregate the line, it's a 1 to 1.5% increase every single year. And one of the interesting points that I make about recessions is that when you have a recession, oil demand doesn't just come back to the pre-recession level. It makes up for that 1% per year growth that they didn't get during that recession. So, COVID was a recession. So now that we're here in 2023, almost in 4 days, a lot of people are comparing oil demand to 2019 levels. No, we need to be 3 to 5% above 2019 levels, and then you can run a recession, a drawdown off that. And you'll see that even if you run a recession drawdown off that, we're not even there yet. So we still have a catch up to go to that point, which means higher demand. And we're seeing that some of the demand numbers out of India, some of the demand numbers out of Brazil, Mexico, South America in general are looking really good. Vietnam, Singapore are just looking really, really strong, including some of the oil production countries where their GDPs are growing 7, 8, 10% per year. So the populations of Egypt, Iran, Saudi Arabia, UAE, they're growing, especially in a high oil price environment. So lots of factors, lots of bearish cases. But when I look at the risk reward on the bear versus bull, I think the bullish side, there's a lot of factors that are going to push the price upwards as opposed to downwards, especially sustained downwards. I don't think the price can be sustained at a lower level for a long period of time.
I've heard some oil bulls describe it as all you need to do is look at the supply side and just forget about the demand side, because there's been underinvestment in oil exploration and development. Companies, even when they're flowing in cash, they're giving that back in the form of share buybacks or dividends. So all you need to do is look at the supply side, and you can see we're going to have a bull market. Number one, would you agree with that? And then number two, for the bears that are apparently, I assume, looking at the same data, how do they come to a 180-degree different conclusion?
Yeah, one of the very interesting comments. So, from a supply side, the data is the data, right? So we look at CapEx and what's happened over the last decade. We are just now getting to the 2014 level of capital investment. Great. There's a few different ways to look at that, right? So some of the bears are looking at it and saying, oh, we're back to 2014 levels of investment. What happened in 2014? The entire bottom of the market fell through. So therefore, the bottom of the market is going to fall through. But we got to think about it this way. We've missed 8 years of investment. So just because we're there doesn't mean that we're at the exact same position we were in 2014, because we need to make up for this area under the curve that's been missed from 2014 to 2022. That's the first point. The second thing is, in 2014 or in 2008, we're producing, to those two years, about 7 to 15% more liquids now than we were back then. So naturally, the CapEx not just has to get to those levels, we need to be higher because we're producing more oil. Oil has a decline rate. One could argue that the decline rate today is much higher on a worldwide production because shale has a 30, 40, 50% decline rate on their legacy production compared to conventional, which has a 6 to 7% decline rate. So if the world decline rate is higher, we need more CapEx just to keep production flat. And then the third sort of thing is the inflation aspect. There's been a ton of inflation in the internal oil and gas space since 2014. So just because we're at the same capital doesn't mean it's like a barrel for barrel number, because now you're paying 40, 50, 80% more per barrel to keep it flat as opposed to we were in 2014. So these are some of the nuances that maybe the bears are not really getting into. They're just saying, they're looking at the graph and saying, oh, we're at this CapEx, which means there's a problem. But the underlying issues that are there have not been solved from 1 year of 1 year of like a decent investment. You need multiple years and you need higher investment for that to get solved. So I definitely agree this is a supply-based problem. When you look at the exploration success rates, they have gone from, call it, 50, 60% in the 1990s and the 1980s. They were hitting these billion barrel pools. Now the success rates are 10, 12, 15%, and the pools they're hitting are 1/10 the size. So not only are they hitting less success rates, but the pools may not even be commercial because they're 100 kilometers offshore. Do you really want to spend $3 billion building a floating platform for a small pool? So there's a lot of nuance like behind the scenes as to why the supply side is not being solved. In the meantime, the old, tired, big fields, what we call the granddaddy fields of the world, are declining. Ghawar field in Saudi Arabia, Burgan field in Kuwait are on their terminal decline. They are suffering from higher water cuts. And these fields just, you can't restore them. It's geology. When you produce half your recoverable reserves, you enter a terminal decline phase. That just is being shown to be true for every oil field in the world. It's even to some extent true for the shale reserves, which is kind of bizarre given that it's an unconventional reserve compared to a conventional reserve. So those are some of the factors on the supply side that I think is worth digging into. I've said this before, and I don't mean to pat myself on the back, but this cycle is really going to be an engineers and geologists cycle, because they have a different view on the macro side of things from that lens, as opposed to just looking at the data and saying, oh, the data says X, Y, Z. Well, look at why the data is showing that, and you get to a different conclusion, as well as sort of from picking the companies that are going to do really well. You need to have a strong engineering geologic background, given that you can't just buy companies that are going to explore these days. There are success stories in that realm, yes, but a lot of the development that's going to be done, a lot of the oil production is going to be from older fields and doing enhanced oil recovery in those fields and trying to produce more oil out of them. So that's sort of where the supply side argument stays. There's a lot of bears that are saying that the shale production can continue to ramp up, and there's a very easy explanation as to why they can't. So we can say, okay, there was 800 rigs in 2014. There was 800 rigs right now. Therefore, oil production should be able to increase in shale by 1 million barrels per day, because they increased with this many rigs, 1 million barrels per day. Then they should be able to increase now, right? That's the argument the bears are using. But let's dive into it and go into one of the nuances. In 2014, the shale production was, let's say, throwing a number out there, in the Permian, 1 million barrels per day. You put a 50% decline rate on that. There was 500,000 of decline in 1 year. So if you wanted to grow 1 million barrels per day, you need to make up the decline plus add 1 million. So 1 plus 0.5, 1.5, 800 rigs was doing that. Now the Permian is producing 5 million barrels per day. Put a 50% decline on that. We need to make up 2.5 million barrels per day of legacy decline before we can grow 1 million barrels per day. So now we need 3.5 million barrels per day of new production to grow by 1 million. And that's really as simple as it gets. When you start diving into the actual math behind it, we need way more rigs, we need way more equipment, and we need way more locations. We don't have any of those. So that's kind of the counter argument to the bear shale, or the bear's view on shale. In sort of one comment is there's nuances behind the data that I think are very important. And what makes this cycle so interesting to me is because you can argue both ways, bearish or bullish. But when you really go into the nuances and what's happening specifically, it's very hard to see a bear case, especially on a sustained level, as I mentioned. Like, can we see $60 oil for a week or two or a month? Sure. But unless there's some catastrophic issue, all that does is affect supply more. It creates more demand. The wedge between supply and demand just gets bigger and bigger. And at the end of the day, we're heading into a European natural gas situation where prices suddenly go up 5x in a matter of 6 months. Not saying that's going to happen in the oil side, but from a idea standpoint, it's going to go up very dramatically and then stay there because there is no solution. Governments are doing their very best to affect supply and subsidize demand. Not a good way to be if you want stability in terms of your pricing and lower pricing.
You mentioned the spike in European energy prices, and we've seen what I would term a reversion to common sense, or a reversion to what works in terms of how they heat their homes over there, and even going back to coal, some nations, because they need coal to generate the heat throughout the European winter. How do you see the ESG and the politicians' war on hydrocarbons and the forced transition that they're mandating away from hydrocarbon to renewables and other green technologies? How do you see that affecting demand, if at all?
Yeah, so we need all kinds of energy. There's this false assumption that because I'm an oil bull or somebody else is an oil bull, that we're anti-wind or anti-solar. No, we want every kind of energy. The issue is politicians and a large part of society as well believe that the transition is going to happen way faster and can happen like on a dime compared to what the reality is. And that's really where the problem lies. Like, yes, wind and solar are eating into power gen demand for oil. However, power gen on oil is only 5%. Like, out of the 100 million barrels per day of oil consumption, power gen makes up 5%. So even if we replace the entire world's power generation away from heating oil, away from fuel oils into these renewable sources, it would be a 5% reduction. And is that going to happen? Likely not. Yes, we can have it in the Western world. Yes, Texas is doing a really good job. California is doing a decent job. There's some other places in Europe that are claimed to be 100% hydropower and whatnot. So yes, it can happen in small pockets, but the overall impact of that is being eaten up by the fact that global oil demand continues to grow from the emerging markets. So India, Nigeria, South America, some of the Southeast Asian countries, there are huge populations in these countries that are moving from bicycles to motorcycles. They're moving from motorcycles to sedans. And they're on this part of the S curve where they are going from zero petroleum consumption to some petroleum consumption. And all of that is just adding up to way more demand than what the renewables have been taken off the markets. I'll also make a comment on electric vehicles. So, electric vehicles are going to be the big thing. We all know we don't have the materials to get there, and it's not happening on as fast of a pace as we'd expected. But there's a secondary problem, which is that the mining for these EV batteries are taking up a lot of diesel and a lot of heavy equipment. As they go deeper and deeper, the ore grades are declining. So now we're having to process double the tonnage of copper to get the same amount of actual usable copper out. And then there's a third problem to it, which is that when you sell a million electric vehicles, So, America, we're selling, I don't know the latest numbers, but let's say 2 to 3 million EVs per year. That's a reduction in oil demand growth of about 40,000 barrels per day. So in a country that consumes 20 million barrels every single day, your yearly EV sales are causing a dent of about 40,000 barrels per day. So it's like, it could happen, and I wouldn't even put it into my model because it's completely irrelevant in terms of the magnitude of what's happening. Now, if they can mandate that every single vehicle sold has to be an EV, and they can somehow produce them, America sells about 25-ish million vehicles per year. Yeah, it could become a bigger deal, but we're nowhere close to that. So until then, it's just like, okay, this thing is going to happen. When it gets to some sort of scale that it needs to be taken into account, it gets put into the macro supply demand model. But right now, there's just nothing. They don't have the scale to really make a dent. But yeah, I guess I'll bring it back to my first argument. We need every kind of energy. The world is thirsty for energy. Energy is what increases people's quality of life. It's what creates jobs. It's what gets a country's GDPs up. And you can mandate anything you want in the Western world, but when people see pain, when they see their heating bill, when they see the gasoline pump a price, when they see what it's costing them to travel across the world, people will realize that, hey, something's gone seriously wrong here, where we used to be able to afford this and now we can't. Meanwhile, people in other parts of the world are burning whatever. They're burning, coal is at an all-time high usage in 2022. People are burning biomass. People are burning wood, right? It's like the human craves energy. And once society is built around energy, it's very hard to get people off that. And we're seeing that, right? We're already seeing protests in terms of the fuel. We saw a lot of issues with people not wanting to pay higher prices. So it's all going to become this thing where, how much pain can the consumer take? How much pain is the consumer willing to take in order to reduce their energy consumption? And I think that pain is that pain threshold is a lot less than maybe people themselves are going to admit to right now, because things haven't really hit the fan in North America yet. In Europe, it has to some extent, and we're going to see it all play out over time.
And has there ever been an energy transition where the governments, in this case, the governments of the world, forced a transition upon the populace and the private sector, and where in some cases you go from a dense energy source to a less dense energy source? Like, I don't know of any historical precedent for the transition that they're trying to fit us into.
Yeah, no, it's that has never happened before. We've never gone to a less dense source of electricity or energy before, and also oil demand has never fallen in a sustained fashion before. So people can run all the graphs they want that show, oh, look, oil demand has been going up for 100 years, and now all of a sudden it's going to start falling. It's just not going to happen. Like, all you got to do is look at coal. What coal did was grew. In certain parts of the world, yes, in North America, it's gone down. But on a global basis, there has to be a flatlining phase before you go into a drawdown phase. Like, it's just unrealistic to expect any sort of energy to have this V-shaped pattern because nothing has ever had that before, other than maybe you can argue nuclear, because they literally shut down facilities after some of the incidents, for good or bad. I think I don't want to argue that side of the portion, but we need all sources of energy, and energy does have its inherent risks, and you just got to decide which risk do you want to take at some point. But you're absolutely bang on. The kind of ideas that are being thrown out have never been executed, and the pace at which people are predicting these things are going to happen, they haven't happened. So why do you keep predicting the same exact thing when the past 5, 6, 7, 10 years show that's not how things have gone, right? So it's easy to get something from a 0.01% penetration to a 5%, like solar in your power generation mix. To get it from 5% to 10% is very difficult, and to get it from 10% to 20% is becoming outright impossible as some governments are finding out. So, the whole linear model thing, I think people need to put a little bit more work into some of these aspirations, let's say.
Yeah, and I don't want to belabor this point anymore, but here in Michigan, where I live, I believe we're 11% renewables. And there was a bill introduced by a representative here at the state legislature level to where they want to take us to 100% renewables by 2035. And there's nothing realistic about that whatsoever. Michigan's one of the cloudiest states in the nation. You're not even going to be able to find enough solar power. People are going to starve. They're not going to be able to heat their houses. There's going to be dramatic humanitarian consequences to such energy policy. And, I just kind of more than scratch my head, get a little frustrated with some of these proposals because I know it directly impacts people's life in a negative way. But could you give us your take on the oil price per barrel next year? Do you do the modeling, as you said? Do you have any models? I know on you have a spreadsheet on your website for the companies you invest in, and you have an anticipated share price or a fair value for a certain price per barrel. But average price per barrel in 2023, would you be willing to share that?
Yeah, I think we're going to go. This cycle from an oil price perspective, there are other similarities, there are other differences, yes. But from an oil price perspective, this cycle is going to be very similar to the 2000 to 2007 sort of cycle. So what you're going to see is this sustained increase in price. It's not gonna go to 200 and stay there next year. If you're asking me what's the average price we end up next year, I would say somewhere between $100 and $120 a barrel is a relatively call it conservative number, with the risk being to the upside. And the reason I say that is because if Russian production suddenly drops off, or if Chinese demand ends up increasing way faster, if they end up doing a stimulus to the property market, you could see that number get pushed upwards. But I think that's sort of the price that I'm running with when I invest in some of these junior companies, when I go into some of these private placements. That's a number I'm running with. The world has used up a lot of their band-aids and their spare bullets, let's say, in 2022. China had to come out of COVID, and it just so happened that 2022 was the year they completely seized up. The US SPR is down 218, I think, million barrels per day, or 218 million barrels in terms of their inventory in 2022. There's other parts of the world where inventory keeps coming down. So once again, I think the nuance, and just to provide a bit of color as to how I got here, people are saying, well, global crude and product inventory is flat in 2022. Okay, agreed. But what's happened? China has stockpiled a bunch of inventory, mostly in the product side. Are they going to release that to the world like the US did? No, China's a crude importer. There's no way they're going to, help subsidize the world's oil consumption if they can keep the oil for themselves. So technically, more of the inventory is now stuck. Also, we're drawing gasoline, we're drawing crude, we're drawing diesel. The three things that are most important. What are we building? We're building propanes, butanes, petrochemical feedstock. We're building heavy fuel oils, the low-value products. So when we look at it as a whole, you can say, yes, crude oil and products are flat in 2022. And you can say, we're not undersupplied. Well, we're undersupplied in the things we use, and we're oversupplied in these random low-value products. So where do we really end up here? And I think there's problems brewing underneath the surface when you look at the data from this more specific lens. And I think that all brings us to this. Okay, well, if China is going to open, we end up in $100 to $120 price. And you look further out the decade. I don't want to be the one saying this is going to happen 5 years down the road, because nobody knows. But it's going to be this slow, sustained increase as opposed to this jack up and then it just like sustains there. That I don't think that's realistic. And that's sort of the model I'm counting on. I've made this statement before, and I think we'll see if it ends up being correct or not. But I don't think we see prices, oil prices, let's say WTI. I made this statement exactly 5 months ago, so I might have to go back and renew this statement. But I don't think we see prices below $100 a barrel for any sort of like 6 month sustained period ever again. That's just the way the price of energy is going up. and then inflation is also bringing everything up. So yeah, that's sort of the one price I'll run with, and then the one overarching statement to kind of run with is if you're looking at investments from a 1, 2, 3, 5 year perspective, that's where I run my model is, hey, can we see sub $100 barrel for 3 months? Sure, but not for a 6 month period ever again.
And so five years is your time frame then for this cycle? Like, do you have a peaking out of the cycle calculated or anticipated at this point?
So this is going to be my bullish side coming out, but this cycle is not going to be a cycle. This is going to be a sustained shift upwards. So pre-2000, we were in the $10 to $20 range for oil prices. Post 2000, we've been in the, call it $40 to $80 range, if you want to say. Sub 2022, we will be, or post 2022, we will be in a new range for oil prices. That's, call it, between $120 and $200 a barrel, and we will stay there with the like, when oil prices collapse, they will collapse to $80 to $100 a barrel, and when oil prices spike, they will go to $180 to $250 a barrel. So there's a new regime per se that we will be in. There is going to be ebbs and flows. Oil is a cyclical industry. Obviously, that's just how it's going to happen. But the range itself is going to be shifted. And so people are going to perceive the cycle as like never having ended because we never get to these $60, $70, $80 oil prices. Yeah, for any sustained sort of period. Yeah.
Shubham, I'm going to have you back to talk about the Canadian oil and gas sector because I want to respect your time. But I as you're talking, I just have so many more questions. Like, so for example, some people think that oil is going to be transacted for gold, not in U.S. dollars. Or then there's things in the news about the petro yuan, no longer the petrodollar. Do you factor these geopolitical and economic events into your forecast?
I think they're great discussion topics, but from what I understand, I focus mostly on oil macro and then oil micro on the company. So I'm no geopolitical expert by any means, but this was mentioned to me. Somebody had messaged me one day and said, "Hey, the U.S. Why are you concerned about the SPR? The U.S. can just use up 3% of their gold reserves and go and refill the SPR 200 million barrels." And I said, it makes sense, but we don't have the oil to begin with. Like, you can't just trade something for like this massive volume of oil that doesn't exist.
Many of my listeners don't believe we have the gold either, by the way. We believe that's a lie, just so you know.
Yeah, maybe I'll leave that up to the listeners because I don't really know. It's like 8,000 tons or something they were telling me.
Supposedly.
Yeah, supposedly, yeah. And then the other problem is that the US has spent so much time and effort and money like keeping the petrodollar alive that I don't think they would use their gold and like kibosh their own interest in keeping the petrodollar as a thing that is priced, like all energy is priced in. So I don't think that happens by any means. I also don't think the petro yuan is ever going to happen because you need to be an energy producer and an exporter really to keep that alive.
So the petro ruble then maybe?
Yeah, you could have a petro ruble, yeah, possibly in that certain part of the world where you have maybe China, India, and some of the maybe Japan and Russia are now transacting undercover between those things. Yes, it could certainly happen. But when we say what is the world's oil going to be traded in, I think it's going to be petrodollar for a long time. Amongst the other sort of conspiracies or this thing around the gold and whatnot is that the U.S. still controls a large part of the Middle East. Maybe not Saudi Arabia, maybe not the UAE, but there's still very, very strong ties to that oil production part of the world. The U.S. has been taking oil from Kurdistan, it's been taking oil from Syria and Egypt and whatnot for a long time. So I just think that the U.S. has too much control on the oil markets to let that go. Really, you don't even need a military. All you need is a control of the energy markets, and you control the world because you can cut off crude imports into China. You can go and block off the Russian crude exports, right? And you can just like literally get oil stuck in certain places and starve people to death. of energy. So yeah, I don't see these as big factors. I think they're fun discussion topics, and they're cool to learn stuff about Russia and the historical presidencies and whatnot. But I don't think these are realistic things that are going to happen anytime soon. Anyway.
Well, yeah. Shubham, I want to respect your time. Rick Rule, who I bring on the show a lot, a very veteran resource investor, he says you need to understand the macro, but you make money by having an informational edge in the micro when you invest in these little juniors. So you invest in Canadian oil and gas juniors, and I'd like to bring you back on the show for another episode in the near future, hopefully, to where you can share with listeners how you approach investing in Canadian oil and gas. But in the meantime, I appreciate your insights today. I'm going to be listening to this interview a couple times myself to wrap my head around some of the things you said. So thanks for coming on the show, and let listeners know where they can find you online too also, please.
Yeah, you bet. No, thanks so much. Always love talking oil. I think so. A lot of my stuff is on Twitter. I like to post supply demand relevant information on my Twitter feed. Kind of one post a day. Usually I'll post some graph. I like the visuals data part of things. I'll put my opinion or my interpretation of it, and then people have the actual data where they can go and make some other opinion of it. So that's really where a lot of my stuff is. I like to participate in a lot of Twitter spaces. So we go and have this back and forth discussion Tuesdays and Fridays usually. And then I've been on a hiatus for a little bit here, but every Sunday I do these Zoom sessions where some are macro focused, some are company specific valuation focused. And more recently, I've been doing a lot of sessions on the engineering side of things, especially with relation to junior companies, and really getting into the nitty gritty as to what's happening with this exact field or with this exact company itself. So those are on YouTube. It's all free of charge. There's nothing, no subscriptions or anything. And then my website, whitetundra.ca, is where, again, all the videos are. My portfolio is fully public as well over there. And then some of the information as to some of the articles I've written. So those would be the best. And I think my email is on there as well if somebody has any specific questions.
And your Twitter and YouTube are linked from your website, I believe, too, right? So listeners could find it there.
As well. And the Twitter is White Tundra SG. My YouTube, I don't exactly know what the username is, but if you just search up White Tundra Investments YouTube, there's about 14 months of content on there. So lots.
And I think you have one video that's like over 6 hours, if I remember, right? You did like a marathon live presentation for over 6 hours of all your research.
Yes. Yeah. So I do these macro outlooks every quarter. So the next one will be coming up on January 30th or like around that time. And I go over supply, demand, inventories. I go over EVs, renewables. We look at the overall broad macro, and everything is data. Every slide has a chart. It's not text. It's not opinion. And I just think like, hey, if you're going to be talking about oil and gas, if you want to be a serious investor, you have to know the macro. I'd rather put it out there in a 6-hour video than do a 3-hour video, and then people are left with questions as to, well, what about this or what about that? So I forewarned people on my previous interviews about the October 30th macro. I'll put it this way: the January macro might end up being even longer. So, but it's gonna be a full 0 to 100 on every single question. People have asked me more questions. It's an iterative process I use. So if somebody says, "Well, you never talked about Brazilian offshore production in your last macro," okay, now we add that slides and then we go on with it. So I think the January 30th one will be a lot shorter because I will focus specifically on US shale. I really want to go into every single company there. But for anybody who's new to oil and gas, you want a full understanding. The October 30th macro, would be your best bet.
Shubham, I predict with the career path you're headed on and the trajectory and just how articulate and well-spoken you are, you're eventually going to be on CBC or CNBC. And they only give you 5-minute time slots. So you're going to have to learn how to condense that 8 hours into about 5 minutes, right?
Right. Well, I'm going to try to do my best. Yeah, I've had some interviews where they've been a lot shorter, and hey, we try to get the point across in that as well. for sure.
Well, you got your point across today. I really appreciate it. And I'll be bringing Shubham back in the future. And we're going to talk specifically about how to invest in Canadian junior oil and gas stocks. Once again, Shubham, thank you for joining me on today's episode.
Yes, thank you so much.